Hello, everyone. Today on the Final Bar, I'm talking with Hima Reddy. She was back on the show in October, right around the lows. We'll see what her toolkit is telling us now. Something to look for next week as the major averages down big today. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using the best practices of technical analysis, the technical toolkit, which I would argue is ideal for this sort of situation. When it feels like things are uncertain, when it feels like the market is finicky, it is anxious, it is jittery, this is where charts can be very helpful. Number one, to help you understand the short-term dynamics, the push and pull from moment to moment, but much more importantly, to build the broader context, right? Understanding how today's moves fit into the longer trends. We were recording earlier today our latest episode of The Pitch, which we're going to be sharing with you tomorrow morning on StockCharts TV, a really interesting discussion about how to pick stocks, how to identify ideas in an environment where the major averages can be down 2 to 3% on a given day, which is what was happening as we were, recording those comments. Really excited to talk through some of these charts. A lot of movements today. At the end of the day, it's what does this one day do to the overall trends? Within the context of the market moving lower, there are some things moving higher. For example, home builders had a decent day with things like Lennar, D.R. Horton up over 3%. So there are sort of bright spots around. We'll try to find some of those together if we could. We have a great guest today, Hima Reddy from HimaReddy.com. Hima was last on the show in mid-October, so perfect to bring her back now and see what she is seeing as she looks forward to the new year. Tomorrow is our last live show of 2022. We will be taking a holiday break to, lick our wounds, to recover from a fantastic year of the Final Bar, enjoy some holiday time with our family. We'll be back live in the new year. Did want to let you know about two things. Tomorrow, as I mentioned, The Pitch is our stock picking, sort of ETF picking discussion. It's a monthly discussion with three guest experts. That'll be airing tomorrow morning at 9 a.m. Eastern. You can find more information on that at stockcharts.com/thepitch. And starting next week on Monday, I will be sharing with you on this show the top 5 charts of 2022. We'll be talking through each a chart a day, Monday through Friday, and follow along. Although we won't have a live show, I think it'll be a helpful exercise to look back through the course of 2022 and reflect on some lessons learned and some key charts to follow. Let's continue on our show today with the market recap. Sort of a quite the interesting day yesterday, right? If you think about it, yesterday, Fed Day, we had the rally sort of into the 2 o'clock hour, the gap lower on the 50 basis point hike during Powell's press conference. I would argue it was, the end. We really didn't change much from the beginning of the press conference to the end, but it was a noisy ride. And by the close, we're sort of right at that 4,000 level today, netting out to quite a negative day. Let's look at the charts and see what actually happened. The S&P 500 down 2.5%. That puts us just below 3,900. Yesterday, we're closing right just below 4,000. We're talking about how 4,000 might be that level to watch. Now, all of a sudden, much lower levels coming into play very quickly as we reach 3,900. Spent much of the day actually below that level, but regained a bit in the last hour and a half to close just below 3,900. The NASDAQ composite, the NASDAQ 100, both down over 3%, leading the way lower in those FANG-like sectors for the most part. We're at the bottom of the list. Mid caps and small caps both down over 2.25%. The VIX moving higher, and Hima Reddy, my guest today, will be looking at the VIX in a little while. We have a little segment later in today's show called Getting Sentimental. We'll look at sentiment information, not just the VIX, but also look at some survey data, options data, and try to pin an overall picture for sentiment. Certainly some big changes today as the market is retracing to the downside. In other asset classes here, very quickly, interesting, you see bonds going higher. So this is not one of those where stocks and bonds move together, which is what's happened a lot actually recently, right? Where you get both stocks and bonds higher or lower. Today, you actually see stocks down big, bonds actually moving higher. So a bit more of a flight to safety with people going into bonds, the TLT up about 0.4%, interest rates coming down with the 10-year yield finishing today below 3.5%. That is further and further away from those long-term highs we saw earlier this year, around 4.25%. The dollar index moving higher today, almost 1% higher for the UUP. Sort of that weak risk assets, higher dollar is the theme that has been the case for much of 2022, but an exclamation point to that move today. Commodities overall lower, although there's some random ones moving net positive, but for the most part, a lot of weakness here with the gold ETF GLD down 1.6%, silver down 3.4%, copper down over 2% as well. So it was not a move into commodities by any stretch of the imagination. Commodities lower, even though energy was the number one sector, but still down today. Finally, cryptocurrencies, a lot of red. You saw a nice spike to the upside going into the Fed meeting yesterday, if I remember right, on what the timing was. From there, we gapped lower along with equities, finished at the lows of the day yesterday. Today, it was just sort of continuing to push to the downside. Bitcoin currently down about 2%, below 17,500. Ethereum just above 1270. That's almost 3% from yesterday. Let's focus briefly on the chart of the S&P 500. And, what we've been talking about, following this chart pretty much every day on this show, it's always about what happens today, and then it's taking a step back. And I'm often reminded of time in the Fidelity chart room where looking at the charts in front of you on the wall was really helpful, but taking a couple steps back from the wall was the most helpful, because then you could really start to see the longer term trends and see how the small patterns fit into the longer term. And I would literally encourage you at times to lean back from your monitor, take a step back from what you're looking at and really think about the longer term time frame. Think about what the trajectory is. I can't help but notice on this chart a general downside trajectory, right? When you look at it, it's this beautiful downtrend channel for most of 2022, lower lows, lower highs, and most recently, we're sort of attempting to get above a lot of overhead resistance. The concern going into late November was, does the market have enough upside momentum to break above Fibonacci resistance around 4,000, to get above the 200-day moving average currently around 40.30, to get above a trend line off of the 2022 highs? And the answer so far this week has been no. There's not enough momentum. We've had a couple attempts to get above the 200-day. It's worth noting both of those have been repelled. So that's a pattern that we first saw actually back in August, right? That was the end of that bear market rally phase in August, was stalling out at the 200-day. Now we're once again testing the 200-day, once again testing the same trend line, which has turned out to be a really good visual sort of representation of the continued downtrend phase. Now we have to start thinking about potential downside targets. Again, with my guest today, we'll talk about the S&P, we'll talk about volatility, we'll see what levels Hima is looking at, and then and talk a little further later in the show. Just to finish off our market recap, I wanted to point out some sector movements. All 11 of the S&P sectors down on the day. Energy was the top performer, followed by real estate and utilities. Now, REITs and utilities, fairly defensive parts of the market. So those being at the top of the list never gives me a warm feeling about the overall market conditions. Energy down only about 0.5%, which is not too bad. The problem was on the lower end, right? So communication services down 3.9%. The XLK technology down 3.7%, followed by materials and industrials. So the growthiest stuff out there having a pretty tough day of it. And that's even as bonds were moving higher, as rates were going lower. You actually have growth stocks going lower, which is a little counterintuitive if you think about that general simple relationship. That makes sense if it's risk off for equities and a flight to safety for bonds. Just to finish off our market recap, as a reminder, there were things that went up, so it's not all bad. And there are things happening. So, for example, CBOE, we're probably not going to get to it, but a bullish engulfing pattern appearing to come out there in a key stock in the financial sector, sort of outside of the big mega cap banks and others. A lot of the home builders here on the top 10 list of S&P members: Lennar, DR Horton, Pulte Homes, all in the top 10, NVR. So these are all names that have had a nice move to the upside. And again, it's always interesting on a day like this when it feels like everything's down, what types of names, what themes, what groups are able to actually show some positive movements. It might not be the perfect signal, but a lot of times can be instructive to see what is working when it feels like nothing is. Let's take a quick commercial break. We'll be back with today's guest, Hima Reddy. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us every weekday after the close for our show. A couple quick announcements before we bring on today's guest, Hima Reddy. First off, we welcome your questions. We had a great mailbag segment on Tuesday's show. We'll do another one on Friday. You can get your questions to us via email, thefinalbar@stockcharts.com. We're also on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on tomorrow's show on Friday. Also, go to StockChartsTV.com. I'm so thankful we have great guests like Hima Reddy, like Dave Landry, like Tom Boley, Larry Tentarelli, Katie Stockton. These are all people we've had just in the last couple of days. A wealth of expertise and experiences to share with you. All of that content is available at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Hima Reddy. Hima's a CMT CEO and founder of HimaReddy.com, coming to us from Austin, Texas. Hima, it's awesome to see you again. How are you?
Hey, good, Dave. Thanks for having me. Awesome to see you, and doing well despite these markets.
I always feel like I have to give an extra thank you for someone willing to come on a show like this, talking about the markets when it's been a big day of dislocation. But honestly, this is when I think the viewers and users of technical analysis need to understand how someone like you, who's had a lot of experience sort of doing this, how you sort of get through this period. Now, you had mentioned before we started that VIX was sort of your happy place. Can you talk about the chart of volatility and what it tells you about the markets here?
Yeah, for sure. So yesterday, just like everyone else, I was paying attention to what the Fed had to say, not just the interest rate hike, but the actual commentary. That on top of the cooler than expected CPI data were the big points this week. So that led me thinking, do I go look at the equity indexes? Do I look at the dollar? Where do I go? And VIX is my central hub I go to first. So what I noticed was that the VIX a couple of days ago, as you can see that large bearish candle we had a few days ago, on your charts, it's near the intersection of the 50 and 200-day MAs. And on my charts, it's on the intersection as well of a trend line that's been in place from the November lows connecting to your early low here that you have from January. So the VIX does really well when you kind of look at old trend line behavior that used to be support and then might become resistance. So that is adding to the fact that there's an important set of levels there on top of the recent highs that are on the VIX. So if you want to just hover over those dates, it's been, November 15th of this year, November 10th, and so on. So to me, what that's telling me is that in the big picture, that is the area that the VIX needs to really surge through in order for the markets to have that tip over of fear. And I just don't see it happening anytime soon, meaning in the next couple of weeks. And that's where looking at what's the S&P doing, kind of fills in and why I see it that way.
Perfect. Let's get to your chart of the S&P. And as you're thinking about this market, obviously a big change in the last couple of days where, it feels like for a couple moments, just a moment ago, it feels like we're breaking above the 200-day and thinking optimistically. And then the last couple of days after the Fed meeting now this week, we're moving to the downside. What are you seeing on the chart? What is it telling you?
Yeah, for sure. So you had mentioned earlier, Dave, that when you're looking at the cash index of the SPY, how there's a beautiful trend line because it's charts. It's all beautiful to us, even if it's down, moving from the early 2022 highs. And the same thing happens on the SPY when you draw it out. And we did intersect that back on December 1st and hit it again on the 13th. So I would be monitoring that line very closely as well. Now, on top of that, I use a lot of market timing and then momentum tools. So I take the RSI like you have down below, and I kind of juice it up with what I call my power zones. So I'm basically looking at the RSI in relationship to the trend of the market, not just as a bound oscillator that was originally designed for sideways trading, which, I'm sure you and a lot of the audience knows. So what I'm seeing is the RSI, when you apply my power zones, it's actually in an area where there's a bit of support. There's recent areas that this has been oversold, meaning in this rally up from October 13th, we have room to go higher. I know that seems very odd given the past few ugly days, but when you bring in market timing, it's pointing to right now between today, tomorrow, and Monday, the forecasts on the VIX, the SPY, and the E-mini S&P that I trade are all saying that this is kind of the energy center, if you will, of whether we get a pause in this down move and like another final attempt higher before some serious damage, maybe coinciding with the Santa Claus rally, or if what we are seeing is the weakness and Santa doesn't come to the markets this year. That's what I'm seeing, and monitoring the support and resistance these next few days very carefully for signs of that.
Very, very interesting, and a bit of a contrarian feel after the sell-off we've had in the last couple of days. Just continuing on the S&P, Hima, if you could, right? What would be the sign that things are getting ugly to the point that this is no longer going to be an optimistic sign, and that we're potentially seeing weakness? Is there a particular level on the S&P, or would there be a certain signal from the RSI that would tell you the momentum is so bad this really is something to be avoided? What would tell you to avoid things in this particular instance?
Yeah, that's a great point. So if we're just talking about, so I always look at things with the direction we're moving in, and then what if the alternate happens? Because as I tell my tribe, I don't have a crystal ball. So if we continue in the direction we're going in, which is clearly down the past couple of days, then that low that you have from November, I think it's the 3rd of November on the SPY, that is a very important swing low, reaction low, whatever you want to call it. Yeah. If we wipe that out before retesting the highs from earlier this month, that is not good news, in my view. That really opens up the floodgates to not only hit those October lows, but go down further well before Q1 ends, in a steady fashion. Now, on the flip side, if we have a rebound here, but the RSI is not able to climb above its recent peak that it just made, then we could end up with a classic divergence signal. And I call those like face-offs between price and the RSI, because where it happens in the RSI matters. To me, not all divergences are equal. So if we get a retest of recent highs, RSI makes a peak and it stays in what I call the bear resistance power zone. So that's a border of about 65 and then falls over, then it'd be like, oof, the bulls couldn't get that last attempt in. And then again, the story would be a return first to those November lows, then October, and then we'll see from there.
There's so much uncertainty in this market, Hima, but I love, as you're talking through some of these levels, it's a good reminder that with a good technical discipline, you can at least have a sense of what levels are important and what levels to watch. It is a pleasure to see you. Thanks so much. I'm so glad you started coming on the show this year. We'll hope to have you back in the new year, but have a wonderful holiday in between, okay?
Thanks, you too, Dave, and to your listeners as well. Good luck, everyone.
That's Hima Reddy. Hima's the CEO and founder of HimaReddy.com, coming to us from Austin, Texas. She has a YouTube channel, by the way, that I was just checking out before we went live today. It's just Hima Reddy CMT if you want to check it out. She shared some charts recently on her YouTube channel about the VIX. I was really excited to hear Hima's take on that. I particularly love her comments at the end about how to think about RSI. We've talked a lot about sort of the phases of momentum, right? The phases of the RSI, how the entire range can bump higher or lower. I feel like talking with Hima, there's the advanced level that I really want to dig into, which is thinking more about the specific ranges and what they could tell you about the configuration of the price action. It was a really interesting discussion there with Hima Reddy. Let's continue on our show today with our next segment, Getting Sentimental. We like to do on Thursdays, checking on some of the sentiment data, sort of see what's happening and what levels and what patterns are most meaningful. And by doing it once a week, we can really track how the sentiment is shifting over time. I thought Hima's chart of the VIX was really interesting. And what I love talking about someone like her is she is much more short-term oriented. She's a trader. She thinks day-to-day about the movements. I tend to be a little more longer-term. So thinking about the short-term dynamics and then how that relates to the bigger picture, I think could be a really, really helpful. And Katie Stockton today on The Pitch was talking, which you can catch tomorrow morning at 9 a.m. Eastern. She was making the point about multiple timeframes and thinking macro to micro, relating those different timeframes and how the signals can line up and often when they can disagree and what that can tell you about the pattern. So it's a whole level of technical analysis that we rarely have time to get into, but I think is really important. My chart of the VIX is really looking a little longer term, but it's thinking about the range, what I call the VIX regime, a volatility regime, sort of that range that we've seen with the VIX. And for me, right, there's this pattern that has emerged, really started in November of last year, which is when the VIX gets up above 30. That's when you want to start looking for an actionable low, which has been pretty successful at picking out those times. When the volatility gets low for this recent history, meaning at or below 20, that tells you that the volatility has lessened to the point the market's probably rallied near an exhaustion point. Now, if you look at those signals in November, really in the beginning of December, is when you saw the VIX get to 30. That was that last sort of swing low before we made a new high going into the new year. From there, the VIX got below 20, kind of unusually stayed below there for quite some time. But from there, you see it settle into a pretty good range. You have a low here in January with a spike higher in the VIX. You had similar spikes in March. You had a similar one in May, in June, and again at the September and October lows there. So every time the VIX gets above 30, then you have to start looking for bottoming conditions and bottoming patterns. On the other side, when the VIX has gotten down to 20, that's lined up pretty well with peak. So in February, we had the VIX at 20 with the price having that first real significant rally off of the move downwards. You had a similar signal on the retest of those levels in late March when the VIX got down there, and then most recently in August at the peak there. And then about 2 weeks ago, right, in early December, we see the VIX once again hit 20. And from there, we're certainly appearing to be in a bit of a distribution phase. So what's interesting about that is it's been a really interesting timing tool in 2022. The challenge is that's not going to last forever, right? At some point, we're going to have more like a 2020 where the VIX gets completely blown out. And that would probably most likely happen in a bearish phase is when volatility tends to expand. Or if we start to recover going into the new year and improve, you could see more of a 2021 where the entire range of the volatility goes down, right? The VIX sort of lessens. So the problem with this sort of indication is that it is temporary, right? Now it's lasted for about 12 months, so it's been pretty decent and fairly consistent. What I would be looking for is when that pattern breaks, right? When does the VIX get below 20 and stay there? And that would probably be a signal confirming a new uptrend, right? Sort of a deeper recovery or a broader recovery phase would be on lower volatility, most likely. On the other hand, if we sell off, it would be the VIX getting to 30 and then not stopping. That's what we saw in March of 2020 when volatility spiked as the downtrend really accelerated. So interesting charts, certainly one of the key charts of 2022, but a lot of question marks, I think, going into New Year to see if that pattern continues and look for those, look for the behavior when the VIX gets to those extreme levels. In terms of the AAII survey, not much change in bulls in the last 2 weeks. Actually, the last 3 weeks, we've seen the bullish number right around 24%. So no big change either way. What has changed is the bearish number this week increasing down to almost 45%. So we once again still have sort of a 2-to-1 ratio of bears to bulls. This pushes the spread of bears versus bulls to a new low here for the last month. And you can see that every week of the last 4 weeks, we've seen an expansion or an expanding gap between bears and bulls because bulls have remained sort of steady. It's like if you're bullish now, you're not changing your mind, but the bears are increasing as things are starting to be a little more questionable. Having said that, we're still in the middle of the range of where we've been for 2022, particularly on the bearish reading. Look at that percentage bearishness. On average, it's right around 45%. We've been as low as almost 30%. We've been as high as just about 60%. We're kind of right in the middle right there. So an average amount of bears, an average amount of bulls, as the market so far is in an average downtrend for 2022. The name exposure index actually spiked higher this week. Now, it's a bit of an interesting development because the market moved down pretty suddenly today. A lot of this survey data is captured before today. And so you're showing a number that's not necessarily reflecting what people would say today after the market's down 3 to 4%. Having said that, the name exposure index actually increased this week up to around 72%. That's up from about 55%, which is what we saw last week. So up until today, you actually saw an increase in positioning in the equity phase or in the equity space by the money managers in this survey. That might be an interesting survey to watch going forward because currently at around 72%, that's almost identical to where we were at the August market peak when the S&P last tested its 200-day moving average. We peaked out at around 72% exposure to equities before we rolled over. This might be an important chart to watch to see if we roll over as well. By the way, the previous peak, which was back here in late March, the indicator got a little bit higher, just above 80 to about 82%, but again, started to roll over as well. Finally, the put call ratios, and I'm just going to spend a brief moment on this because I'm convinced that I don't want to say the put call is broken, but it's certainly changed. And after last week's show where you saw the put call ratio, we looked at the equity put call ratio, which is this one right here. You see how noisy it is. Now, again, the raw data is in gray, and I have that muted kind of in the background because it's so noisy. It's a daily series, and I'm usually looking at this every week. So I try to focus more on the change in that indicator, which is why I use the 5-day average, which is the bright pink line. But having said that, the gray lines are the raw data, and you can see how noisy this indicator has become. Kind of had a certain level of volatility until about 2 months ago, and all of a sudden it starts getting really whipped around and spiking to incredible highs. I reached out to a number of options expert people in my network, some who have been trading options for longer than I've been alive, to be honest with you, with great success. So I chose what they're saying. Most of them, a number of different theories, but most of them have talked about the change in structural trading in the options market. So you basically have the super short-term options that have become much more popular. The exchanges have been pushing those to a great degree. As a result, you have a lot of new participants changing those. As a result, that is dramatically impacting the put-call ratio. So what does that mean for us using that as an indicator? That has happened many times in my career. When I first started in the industry in 2000, we were just getting going with decimalization. That had started, and stocks were going from trading on 8ths and 16ths and 32nds to all of a sudden, trading to decimal points and then sub pennies eventually. That certainly changed things like advancers, decliners, because all of a sudden the number of ways there, the number of incremental differences between up and down, all of a sudden were very, very narrow. And so it certainly changed the configuration of those indicators. I wouldn't be surprised if we're going through a similar adjustment with some of the put call data. And it might take some time for us to adapt the indicator to this new reality, or this might be a temporary thing. Having said that, I'm putting a lot less weight on the extremes in the put call ratio because it seems more like a structural change than a market signaling type of pattern. So thanks a number of you that wrote in and caused me to lean into some of my options experts in my network, and it was great to reconnect with them and get some of that color back for you. We need to wrap this show, folks, and go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. One of the breadth indicators, we didn't talk a lot about breadth here today. We'll probably talk a little bit more on tomorrow's show on Friday, which will be our last live show of 2022. But one of the things that we will most likely talk about is a decline very quickly in the last week on some of the breadth indicators we're looking at. We've highlighted when the McClellan oscillator has fluctuated. We've highlighted the bullish percent indexes that have gone back and forth between buy signals and then sell signals. The percent of stocks above their 200-day has gone from around 65% to 53% as of today's close. Also, the percent of stocks above their 50-day moving average in the S&P 500 peaked just over 90% about 2 weeks ago. We're finishing Thursday session here around 67%. The reason why this is important is, generally speaking, I have these pink horizontal lines to indicate the 50% level. I have found as a general guideline is when these indicators are above 50%, they are bullish, telling you most stocks are in that configuration, bullishly speaking. If it's below 50%, that means we've now crossed this sort of imaginary threshold where now most stocks are below their key moving averages. I would watch that going into this weekend and certainly going into next week to see if those indicators get below 50%. Right now, as my guest Hima Reddy was talking about, it's about a drawdown and what potentially would find a floor there. I think with some of this breadth data, we can maybe get a sense of the potential of those levels to hold or not. Chart number 2 is the regional banking ETF KRE. As a preview, I mentioned the pitch, which will air tomorrow morning at 9 a.m. on StockCharts TV. One of the 15 ideas we talked about was a short KRE, shorting the regional banks. You'll have to watch the episode to see the full details as to what motivated that idea, but I thought it was an interesting group. The stock, or the ETF, obviously breaking down in the last couple of days, along with many things, nearing a key support level. $56 a share was key support in June. In July, we're really close. We're at a rounding error of that low. We're becoming oversold as of today's close. So it'll be very interesting. We are oversold as we test support. Is this the time when this bounces, or do we fail to hold support? And stocks and ETFs approaching support and being unable to hold them is often a very negative sign. Final chart for the day, Vale, V-A-L-E. This is another chart that was discussed on the pitch. Again, check out that episode to get the full details. It was a great reminder, a great example. Even when the markets are struggling, what they certainly are this week, there are charts like Vale, which are just nice setups with strong uptrends, decent pullbacks that have been resolving to the upside. Apparently, all is well. Folks, we need to wrap the show. Thanks so much for joining us every weekday after the close. A special thank you to Hima Reddy, founder of HimaReddy.com, joining us from Austin, Texas. All of our previous interviews can be found at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Go Seahawks. Be well. Have a good night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.